Hey everybody, it's Erik Torenberg, co-founder, partner of Village Global, a network-driven venture firm. And this is Venture Stories, a podcast covering topics relating to tech and business with world-leading experts. Hey everybody, welcome to another episode of Village Global's Venture Stories. I'm here today joined by two very special returning guests, Lyn Alden and Scott Sumner. Lyn, Scott, welcome back to the program.
Thanks for having me. Happy to be here.
Thank you for inviting me, Erik.
So this is the part two. I want to get into the trade deficit and how we think about international trade. Maybe we could start with, Scott, inflation is all the rage. Percentages are high. People are getting concerned. Prominent people in technology and business are declaring inflation. Jack Dorsey is even warning about hyperinflation, or he tweeted about it. Why are you not concerned, or what do you think that they are misunderstanding?
Well, I wouldn't say I'm not concerned at all. I think there's some risk of high inflation, excessive inflation going forward. If you look at the financial markets, they're predicting inflation is going to be elevated for a little while. It's a little unclear, a year or two of relatively high inflation. And then the financial markets are saying it's going to go back to about 2%. So obviously, that's just the market prediction. But as you know, my philosophy is the market prediction is the least bad prediction. So that's kind of what I would go with. And so I do think that, monetary policy currently is probably a little bit too expansionary because of the fact that we're probably going to overshoot the Fed's 2% average inflation target. Yeah. So, but it's not, I don't think anything like hyperinflation I don't even expect like double-digit inflation over the next few years, but I do think inflation will be a problem for some period of time before it comes down.
You mentioned you don't think it will go above 3% on average for
the decade. I think I said that for the decade. Yeah. And I would stick with that, but obviously inflation's run, depending on your index, 5-6% recently. And it probably will continue to run high for a while longer. I'm not exactly sure how much longer, but again, the financial markets are predicting that inflation will come down to around 2% for most of the 2020s.
And what is the mechanic by which inflation would go down?
Well, the Fed has to adjust monetary policy to slow growth in spending. And, recently growth in spending has been very rapid. And that's what's driving the inflation, combined with the supply bottlenecks. So I should say it's a little misleading to try to pin it down to either supply side inflation or demand side, because, it's really a combination of the two. So you could say truthfully that, if we hadn't done all this stimulus, we wouldn't have a lot of inflation despite the supply problems. That's true. And given the amount of stimulus we did, if we didn't have the supply problems, we wouldn't have a lot of inflation because nominal GDP growth over the last 2 years has been quite moderate. So it's really the combination of the supply problems and the growth in spending, and specifically the big movement from services to goods. As you probably know, the service sector is depressed and the goods sector is in a flat out boom. And it's hard for an economy to move on a dime and transition from producing one type of goods or services to another type. Yeah.
And Lyn, Scott just described how, market predictions say that will come back down. Why don't you take as much stock in the market predictions?
Yeah. So overall, I would say I agree with a lot of what he said. I think that basically what we have is a demand and supply issue currently. And the way I'd phrase it before is that if you get a rapid increase in money supply and other kind of stimulatory efforts, then it comes down to how constrained you are in terms of real world resources, usually tied to commodities in some way, but can also be things like supply chains and things like that. So for example, if you imagine a hypothetical economy that was 100% software, if you dramatically increase the money supply, you're unlikely to get price increases, or at least, rapid price increases, because you're not really running into a constraint, but in one that's really confined by labor or commodities or shipping, infrastructure, things like that. Then if you have that kind of tight, situation, which is not, it's not equally tight decade by decade. There are different commodity cycles and building cycles. And so overall, I view it similarly that we've essentially, in some ways, overstimulated and run into supply constraints in some areas. The part I would differ on is I think that, when basically central banks are large accumulators of the sovereign debt of multiple countries throughout Europe, Japan, the United States, that bond market ceases to be as useful as a forward indicator for what inflation levels are likely to be, because pretty much by definition, they're taking excess supply off the market, letting the market price the remaining amounts of it. So it still gives us informational value, I think, in a tactical sense. So when bond yields dip and then they go up again, I think it tells us about the next couple quarters, maybe about these kind of cycles that we go through. But I don't think it's very informative about forward long-term inflation expectations in this environment. For example, a decade ago, we had the European sovereign debt crisis. And essentially what backstopped that was that the ECB was willing to come in and buy bonds as needed in order to, fix that supply demand mismatch. And now we see that they're the majority buyer of many of their bond markets. And so overall, it's not like those situations got better. It's just that the market understands that there are different dynamics at play now. And so I think that I'd be very cautious about forward inflation expectations. That's something I've been writing about since 2020 because we started to see that disconnect start to build. You could look at different commodity ratios and different kind of real world kind of measurements and see what rates probably should be in that kind of environment. And you can see that rates were not keeping up with it. When you combine it with, say, the central bank language, I mean, the Fed talks about in their minutes that one of the reasons they buy the long end of the curve is to try to suppress it. And that doesn't always work on a kind of a month by month basis, right? So it's actually kind of ironic outcome where, during rounds of QE, yields, if anything, tend to go up to some extent. So it's not like it suppresses it in the near term, but what it does is it takes excess supply off the market and basically makes banks very reserve heavy.
Scott, how does that correlate with your model of the world?
Well, I agree that the tip spreads are not, probably an optimal forecast, but I don't really know of a better one we have. I will say that I believe the Fed is both buying conventional bonds and tips in significant quantities. So I'm not sure the spread is being distorted that much by Fed purchases. Also, the total size of the national debt has really dramatically increased in recent years. So even though the Fed's holding of government bonds has increased quite sharply, both in the Great Recession and this time around, there's still a huge increase in the amount of debt not held by the Fed. So it still has to be priced, at a level where people are willing to hold both conventional bonds and tips. Yeah, I do think there's distortions, and there are times when I'm suspicious of tip spreads myself, especially when the market's highly illiquid in a financial crisis. But broadly speaking, I think it's probably about the best forecast we have, and some of the other indicators, are, I think, sort of telling us the same sort of thing. So I guess overall, I'm still inclined to think that inflation will come down after a period of high inflation. But again, in my mind, this all depends on what the Fed does. So, the Fed is capable of reducing inflation. They're committed to it, but obviously I can't guarantee that they'll do what they say they're going to do. All I can say is it looks like to me, the markets think that they are in fact committed to a 2% long-term inflation rate.
And how much, Scott, do you put little weight on what happens with fiscal policy? If fiscal policy goes crazy in the next decade, do you think that still it wouldn't make a big impact on the inflation?
For the United States, I just don't think fiscal policy has much effect on inflation. Now, in other countries where you have fiscal dominance, Venezuela, Zimbabwe, et cetera, obviously that's different. But in the United States, the size of the fiscal deficits is not enough to force the Fed to abandon its 2% inflation target. If it abandons that target, it would probably be for some other reason. Like in the 1960s, it allowed high inflation, not because of the budget deficit, which was small at the time, rather to pursue goals like low unemployment and helping Nixon get reelected, et cetera. So if the Fed does abandon the 2% inflation target, I think it would be due to a misguided attempt to create, extremely high levels of employment or to do some other goal that the Fed shouldn't be trying to do.
Yeah. I think one thing that was a difference between you two is I think Scott believes that the debt to GDP ratio isn't a huge thing to be worried about. Lyn, you have your point that in 52 out of 53 situations where the debt to GDP ratio was as high as it is now, companies inflated away their debt or some version of that. And I think I asked that to Scott, and Scott said, hey, this time is different because it's likely that real interest rates are lower this time. Scott, is that an accurate representation, or what would you edit to that?
Yeah, I mean, first of all, when you quote these kind of statistics, and I haven't looked at this as carefully as Lyn, so I'm going a little bit out on a limb here, but when you look at these numbers, I think you have to recognize that there's a lot of kind of correlation between countries. So you've got this big group of developed countries that have historically behaved a certain way regarding their debt and their monetary policy, their inflation policies, and so on. And a good example is Bretton Woods, where most of them had roughly the same inflation rates. And then you've got another big group of countries in the developing world that occasionally have real fiscal problems and engage in money printing to paper over those problems. I think Argentina is probably a recent example. And there's a lot of countries like that. So when you look at a historical period like the 20th century, you're likely to find a correlation that largely reflects the class of countries you're talking about. Okay. Now, I'm not saying that's entirely the case, that there's probably some developed countries, that had very high inflation as well. But I do think that, when you get into the 21st century and you have permanently lower real interest rates, seemingly, and politicians seem to care more about the interest burden on the debt than the size of the debt itself, that's pushing a lot of countries to, increase the debt to GDP ratio. And so we're having sort of an experiment on a grand scale all across the developed world. And I don't think we know yet whether that's going to force them to become like Argentina and eventually, monetize this debt by printing a lot of money. Time will tell. But I think that when you look at these numbers, you have to remember, to some extent, you're looking at classes of countries that are very correlated with what they do. So I would just say to be careful. I'm not saying Lyn's wrong about that. It's certainly, I think we're actually on the same side politically. I oppose the large budget deficits. Right now, I'd like to see them smaller. I'm opposed to the current fiscal stimulus that's working through Congress, but I'm probably a little bit less concerned about the inflation consequences.
How would you respond to all that, Lyn?
I think a couple points. One is, I do view fiscal policy as being an important factor for inflation. That was probably the central point of why I expected the inflation we got here in 2021. And the reason essentially has to do with, the way I would describe it is that the Fed, central banks in general, are useful at suppressing inflation, but their tools are limited for increasing inflation if it's running under their target, because they have limited abilities to, say, direct money to people, right? They can manage interest rates and they can buy assets, but they don't really have a mechanism to spend. And so I would say a large part of this supply-demand mismatch that we're having, as well as the increase in the broad money supply over the past couple of years, is that you run large fiscal deficits and you get that money out into people's hands that they can then spend and pay down debt, things like that. And these are generally these more inflationary policies. And the Fed's role essentially is to take excess, treasury supply off the market and kind of facilitate that, ensure smooth functioning liquidity of the sovereign bond market to the extent that they can. And so they're kind of just not putting the brakes on at that point. And so, I would kind of separate those two to some extent in that regard. As for, high debt levels generally being inflationary, the way I would describe it essentially is that both developed markets and emerging markets, they generally go through it in different ways. So that study showed that when debt to GDP gets that high, that debt is not paid back one way or another. And if you look at the emerging markets, they're more likely to do things like outright default or experience hyperinflation, things like that. Generally the more extreme sides of the spectrum. Developed markets are generally more likely to do something in the middle, which is essentially financial repression, which is that you get a period of higher inflation and lower rates. So you get kind of a structural period of negative real rates. And that basically makes it so that those bonds, and a large part of it does not get paid back in terms of purchasing power, but you have less extreme outcomes generally than what you find in emerging markets. And that's because, unless they lost a war or other sort of massively disruptive thing to their base, they didn't have a huge downturn in productivity or kind of, that lost kind of foundation. And because also their liabilities are denominated in their own currency, And so they're kind of able to manage that in a somewhat smoother way. And so overall, I would describe that, in this era of very high debt to GDP, so I do think that the interest expense is a key thing to watch. And that's why I view essentially that bond yields are likely not going to represent, say, year-over-year CPI, for much of the 2020s, that you're going to have this ongoing disconnect. Like right now, it's pretty extreme where you have 6% CPI increases and zero rates. I don't know if that size gap, I think that gap, you could have periods where that gap gets bigger. You could have periods where that gap gets smaller. But I think when you look back at this decade from, say, 2030, I think you're going to see that bond yields were persistently below the prevailing inflation rate. And actually, if you look back over the past decade, that already happened to a mild extent with T-bills. So T-bills spent the majority of the 2010s decade yielding below the inflation rate, whereas long bonds fared somewhat better. And I think the 2020s, you're going to see that across a bigger portion of the duration spectrum, possibly all of it, like we're seeing now, and that the magnitude will probably be larger because of the more fiscal heavy environment, and the fact that the 2010s were kind of characterized by commodity abundance, and also basically China had a very different role in that decade, whereas I think going forward we have this kind of not deglobalization, but maybe less ongoing globalization, kind of a pause in globalization, mixed with the fact that commodity cycles are generally a little bit more scarce now. So when you combine fiscal policy with the real world constraints, and then the high debt levels that kind of necessitate low interest rates, I think that's where you get that kind of currency devaluation mix. Whereas I don't use phrases, I don't describe things as hyperinflationary, things like that.
Scott, how would you react to that?
Well, I think that my problem here is that although the current inflation burst we're seeing now is consistent with the notion that interest rates are being artificially held too low, if you take a longer view of, say, the last 40 years where we've had steadily lower interest rates, I mean, there's kind of two theories of what that's all about. One theory is that the equilibrium or natural rate of interest has been falling for 40 years. That's my view. Another is that this long downward trend has been artificially created by central bank policies. And some people may hold some mixture of those two views as well. But so until this recent burst in inflation, I just think there was a lot of evidence that we're on a long-term downward trend in equilibrium interest rates that isn't really being produced by easy money policies. It reflects long-run structural changes in the economy, savings, investment, et cetera, demographics. And for that reason, I'm not as concerned about inflation coming out of this low interest rate period. Like if a central bank actually held interest rates well below their equilibrium value for any sustained period of time, you should get very, very high inflation. And one of the reasons the Fed abandoned interest rate targeting in 1951 is that it seemed to be pushing inflation much, much higher. So we'll have to see. Obviously, we're in a period of higher inflation, and there's two views as to whether it's transitory or permanent. And I think how that plays out will influence people's judgments as to whether interest rates are being held way too low or not. But I'm still of the view that these low interest rates reflect structural forces in the economy, that they're not artificially created by central banks, and they're not going away. In other words, I think the 21st century is probably going to be a low interest rate century, or at least many decades of the century. So, I guess there's a little bit of a difference there in nuance, at least.
And Lyn, why don't you believe it's naturally or free falling as Scott's proposed, or what would you need to see in order to change your view?
Well, I mean, if you look at that whole 40-year period, I think you've reached a point of unusually high interest rates. So, and that that was. You had the issues with the 70s. You changed the way the monetary system was structured. You ran into a major structural change in oil. So, for example, United States oil production peaked in 1970 and then went on a multi-decade downtrend until the shale revolution, right? So you had real world resource constraints combined with going off the gold standard, rapid increases in broad money supply. And so we entered around 1980, we entered that totally different regime. And so we entered, I would say that a large part of that declining interest rate over those decades was natural. I mean, that those levels were not sustainable at those super high rates. And part of that comes down to demographics and things like that. So you stabilize the financial system, and you had the developed world have much slower demographics. And then in the 90s and the 2000s, you had an uptick in globalization. So with the internet and with other technologies, you could do labor arbitrage and basically disconnect, say, worker productivity from worker wages at a bigger rate than was historically before then. And so you had a combination of technology deflation and demographics deflation that I do think a lot of that was naturally interest rates going down. Where I would draw the line is after the global financial crisis and the uptick in quantitative easing. I think that's where we entered a different era where interest rates are going to be less reflective of inflation levels going forward, with basically central banks willing to take excess supply off the market and basically do, in Europe, you might call it spread control, say between Italian bonds and German bonds. And you have, in some cases, you had formal yield curve control like Australia over the past couple of years. And then also you just have essentially just buying large amounts of the market, taking it off. You also had a change in regulation. So, for example, you have money market accounts are holding more treasuries than they used to. There's different regulations to kind of keep treasury bills kind of at the heart of the system to make sure that they're always there's a big demand for them for collateral. And so I view it as a combination rather than one or the other. So I think that overall, I agree that this will be probably a low interest rate few decades. I just don't necessarily think that inflation is also going to be low. I think you can get a period in the 2020s where inflation is pretty elevated. And I don't think it'll be a straight line. I think if you look at the 40s and the 70s, those are both very inflationary decades, for example. And it wasn't just like you had a straight line up of inflation the whole time. They went through waves. So they had higher inflation, then they had lower inflation. Some of that was from wage and price controls, but other things were because you had shifting real world constraints. You had central bank attempts to pause that. You had sovereign government attempts to pause that. You had different kind of mechanisms going on. And so I think that there will be periods, maybe late 22, 2023, where you have a cooling off of inflation, for example. But that doesn't mean you can't get another round of it deeper into the decade. I would expect waves as a base case.
If you had if Scott proposed 3% or not exceeding 3% as a guess for the decade, do you have a guess or prediction for what the decade averages might be?
So I guess the conservative measure that I've been saying is that I expect the 2020s to be higher average inflation than the 2010s, which is a pretty low bar. So 3% would already meet that criteria. My base case would probably be somewhat above 3%. But coming to an exact number is challenging because I would agree with Scott that's where it depends on what they do, right? So it partially depends on, not just Fed policy, in my view, but also fiscal policy, right? So, how elections turn out, whether there's fiscal gridlock, whether the Fed, kind of gets more aggressive or less aggressive. It also, I think, depends on what country you're looking at. So I probably would take the over on that. But anything, over my base case, essentially higher than the 2010s decade, and potentially by a significant amount, but we'll see.
You both overlap on lots of things. One thing you differ is, I guess, you're more, you, Lyn, are more trusting or believe stronger that fiscal policy can, has effects here. What do you see differently about the world that leads you to that prediction, where that and versus what's led Scott to his belief there?
Well, that's hard to answer because I haven't researched exactly how he got to his view, but I would say for me, what showed that view was going through historical data and seeing the important role that fiscal policies played, and how that has been a large component of, say, broad money supply growth, and then correlating that with those periods of supply constraints. So you see, generally, if you map out broad money supply and CPI, going back 150 years or so across, multiple developed countries, you'll see a pretty strong correlation, but it's not a perfect correlation. I would describe essentially that rapid broad money supply growth is a necessary but not sufficient variable for high CPI. And so you generally don't see high price increases. It's hard to get a broad increase in prices without a broad increase in the money supply, but you can have the opposite. You can have periods where money supply goes up quite a bit, and due to technology deflation or other variables, you don't have that supply constraint, and therefore you don't have high prices going up. And there's really two ways to get broad money supply growth. One is that banks can lend, which, for example, was fueling the 1970s inflation, and part of it was then you had fiscal deficits towards the end of that as well. but a lot of that was bank lend driven, and it ties into demographics and things like that. Whereas if you look at the 40s, that inflation was not bank lending driven. That was almost entirely fiscal driven. You basically the government would run very large deficits, and then the banking system and the central bank would essentially monetize that as needed. And so I view that fiscal policy is one of the two levers that they have, aside from just commercial bank driven, which is not really a lever that they can pull for increasing the broad money supply. So I track that, and then I track just commodities and other kind of measures of real world constraints.
Scott, how do you interpret that data differently?
So I guess I differ a little bit on the periods when you don't have the expected rise in prices associated with monetary stimulus or fiscal stimulus. I think Lyn mentioned things like technological progress and so on. The thing I focus on is the demand for money. So there's certain periods where these are sometimes called like the liquidity trap periods. Very low interest rates. People are wanting to hold a lot of liquidity, the 1930s, the Great Recession, and so on. And as a result, you can inject money in the economy without getting a lot of inflation. It's hoarded by the public or by banks. And then you go into a period where things are more bullish, the economy is booming, say World War II or other periods where that same amount of money that's been in the economy for a while but hasn't been creating inflation does begin creating inflation because velocity of circulation goes up, which is the flip side of demand for money. So it means lower demand for money, higher velocity. So I see what's happened is that sometimes like the 40s is a delayed reaction to money that was already injected in the economy during the Great Recession, but wasn't circulating with a high level of velocity. And, that I think that occurs throughout history in some of these cycles. But I want to make one other point, circling back to the interest rates. A useful way of thinking about my approach is that sort of a first pass is that nominal interest rates are related to nominal GDP growth, and nominal GDP growth is determined by monetary policy. Okay. So for instance, during the 1970s, nominal GDP growth was really high, close to 11% a year. So you don't have to go to like an oil shock to explain why we had a lot of inflation and high interest rates and so on. That kind of nominal GDP growth coming from monetary policy would create the same thing regardless of what happened to oil prices. Conversely, nominal GDP growth slowed to about 4% in the recovery from the Great Recession. So that's a slowdown of about 7 percentage points. But the surprising thing to me, and the thing I didn't expect, is that nominal interest rates have fallen even by more than nominal GDP growth has fallen. So even though we've gotten back to like a 1950s inflation environment, our interest rates are even lower than then, right? So that's the part that's kind of surprising to me. And what that means is that there are some forces that are pushing interest rates to an unusually low level, even given the nominal GDP growth rate slowing quite a bit. And, I think Lyn and some others might say, well, that's a repression, the government or the Fed artificially holding rates even lower than would be justified by that slowdown in nominal GDP growth. In my view, it might be due to demographics, savings, investment shifts in the global economy that are hard to understand, but are pushing rates lower globally. But I still think that's kind of a poorly understood phenomenon. So in other words, there's two parts to this long-term downward trend in interest rates. An easy part to explain, slower nominal GDP growth produced by changes in government policies, fiscal and monetary, and even lower interest rates than would be expected given that slowdown in nominal GDP growth. So dividing the problem up into those two pieces, I think sometimes makes it easier to kind of understand where the differences come in.
And is there anything you'd add to that, or did Scott summarize the difference as well?
I think he just described it well. I think, basically the only thing I would kind of differ on is that I think the importance of real world constraints are pretty critical, and that there is a big difference when you have a period of essentially commodity oversupply, right? So commodities tend to go in these really big, say 10, 15-year cycles where, because companies don't even control the price of their own product in that industry, right? Unlike most other industries, there's no differentiation. And so you have this period where, say, commodity prices are high, there's not enough There's either too much demand or not enough supply. So producers come in, they make more, they find more, they put money into the ground, they eventually find more, and then either you get a slowdown in demand, or you just brought so much excess supply to the market that you've essentially flooded the market, and you've created a structural period of oversupply. And because you have big mines or big oil fields, things like that, that oversupply can last for many, many years. Same thing with periods of undersupply, because it can sometimes take years to bring on these new giant resources. And so you tend to go through these big cycles. And so you generally see a bigger disconnect between money supply and inflation during periods where those commodity cycles are pretty abundant, when there's less constraint about the commodities. So generally these periods of kind of bigger disconnect, it's more able to happen in that type of environment. That's one thing I would kind of view as different.
Yeah. I want to segue over to globalization, but Scott, do you want to have a last comment on that? Or?
Well, yeah, I think commodities are important, but more for the shorter term cycles. So I think Lyn mentioned that in the 70s, inflation wasn't constant. There were big spikes in 74, 1980, and so on. So I see the commodity cycles as explaining why there's this big year-to-year variation. But I think nominal GDP growth does explain the longer term inflation, because even in the 70s, real GDP grew over 3% a year. So that's a solid performance. So you can't say overall that the 70s inflation was a supply problem necessarily, but definitely the peaks of inflation in the 74 and at the end of the decade, those were commodity supply problems and very high commodity prices. So I think it's the difference between long-term inflation trends and cyclical trends in inflation.
So I want to segue into a topic you write quite about, Lyn, which is sort of the Triffin dilemma as it relates to being the global reserve currency. So you talk about the pros that comes with being the benefits, i.e. the higher standard of living, advantage in militarily, because you can print your own currency to buy commodities and other imports while other countries can't. But you also talk about the real downsides that maybe it aren't quite widely known. You talk about it being the Triffin dilemma, which means that what results from the global reserve currency is a persistent demand for dollars, which means there are perpetual trade deficits to service the dollar supply, and trade deficits can't last forever, and so debt builds up until it becomes unmanageable, and that this is inherent in being the global reserve currency, and has had side effects like shifting our supply chains overseas. Manufacturing in the 70s used to be 30% of US GDP. Now it's 11%. Industrial at large is 19% of US GDP, while world average is 30%. What would you add or edit to my description?
I think I would characterize it as every time we kind of order how the global monetary system works, there's usually one or more unsustainable aspects of that, basically a resource that we start drawing down from in order to maintain that system. And if you look back at the Bretton Woods, you had the original Triffin dilemma, which is about the capital account. And if you look at how that system functioned, one of the imbalances in that system was that U.S. gold reserves kept declining, while the amount of dollars outstanding outside of the country kept increasing. So essentially, Americans could no longer redeem dollars for gold, but the foreign sector could, the foreign official sector, and that's what still maintained that peg to some extent. But because of the combination of the euro dollar market and just running deficits and money supply growth and all sorts of factors, the number of dollars outside of the country kept increasing, and treasuries as well kept increasing compared to the amount of gold that the United States had. And so eventually you had this constant decrease in the gold supply, until they had to say, look, this is not working anymore. We can't really maintain this backing. And so, we're closing the gold window. And the way I would describe the system that came after that from the 1970s and onward is, so we replaced essentially gold with treasuries at the center of the system. And so treasuries became increasingly the asset that is held on central bank balance sheets. And the challenge there is, so the United States made a deal with Saudi Arabia and other countries to only price their oil in dollars. And that means basically any country in the world that needs to import oil needs dollars. So they and they can get it in multiple ways. They can exchange their currency for dollars, or they can start pricing their own exports in dollars to get dollars. So there's multiple ways to do it, but essentially they need to accumulate dollars in order to be able to import oil from those countries. And the challenge there is that gives it gives the United States multiple advantages. We can sanction countries. We can essentially cut them off from the lifeblood of the system. It gives us more global reach, things like that. One of the downsides, if you look and say, okay, what's the imbalance in this system? What is the resources being drawn down? And essentially, it's that with all that global demand for dollars, that essentially gives us a version of Dutch disease. Whereas basically you describe it as, instead of finding a big commodity area, the commodities that we found are treasuries and dollars that the world needs now. That we've kind of engineered that they need it, and so now they have to get it from us, which sounds good. But essentially what happens is, so the United States has been running these structural trade deficits now for decades under this system. And those dollars essentially find their way back into, either they used to go back in the treasury market. So we, foreigners would then take those dollars that their trade surpluses, and then they would buy treasuries and use them as their foreign exchange reserves. But as we've entered, especially over the past decade, as we've entered this period of kind of, rates being below the inflation rate and treasuries no longer being particularly attractive assets, some countries have kind of stopped doing that. Instead, China would say take their dollar surpluses and go out and make loans to different countries around the world and use their dollar assets in that way. Or you have other countries like Switzerland taking their current account surpluses and putting them into U.S. equities as a way, at least part of it to get that different kind of exposure. And so essentially, I would say that one of the downsides of the system is that it fuels some of the wealth concentration in the United States that we see. So if you look at, say, Credit Suisse data on median versus mean wealth in different developed countries around the world, the United States is one of the highest differentiators between the mean and the median. You could also just measure by the Gini coefficient, different ways to measure wealth concentration. And I would argue that's in part because we've drawn down our manufacturing base at a faster rate. Our industrial sectors become a smaller percentage of our total GDP than those, and that we've also simultaneously propped up our asset prices to a bigger degree because we keep cycling our trade deficits back into financial assets. So there's a lot of moving parts there, obviously, but it's a topic that I kind of like to focus on, because every system that has benefits usually has some sort of drawbacks, and it's important, I think, to identify where those are.
And you mentioned earlier, sort of the prediction of upcoming or forthcoming, not exactly deglobalization, but some version of that. Can you talk about your prediction out in terms of what you think the next system might look, or your lack of system might look like? How do you think this is going to play out?
So two parts there. One is globalization. If you measure it in one variable, I would describe it as global trade as a percentage of global GDP. And there's research on that going back to the 1800s, and there's a general structural trend towards higher globalization until, of course, around World War I. Then you enter this multi-decade period of deglobalization, where you had two world wars and you also had tariff wars in between. And then after World War II, with the reformation of the kind of global order, you had another multi-decade trend of globalization. So more and more trade as a percentage of global GDP. It kind of paused in the 1980s, but then when you had the end of the Soviet Union and the opening of China, throughout the 90s, you had another big leg up in globalization. And that kind of peaked around global financial crisis. So since around 2008, global trade as a percentage of global GDP has kind of been like flat to even mildly down. So we haven't like rapidly deglobalized or anything like that. That's a very long structural trend that doesn't just reverse on a dime, but we've kind of ceased further globalization based on that particular measurement. And I think as in recent years, as you've seen more tensions between, say, the United States and China, and now that we're seeing kind of some of the consequences of having such a globally efficient kind of last minute supply chain, I think in some ways it's arguable that we've kind of reached peak globalization, at least for the next few decades. Then we could enter another period of either contraction in globalization, or at least just a leveling out for a period of time. And that, all else being equal, is an inflationary force, because I think part of what made the natural interest rate go down and natural inflation rate go down in the past couple of decades was this global arbitrage, basically finding cheap markets around the world, cheap labor, cheap manufacturing capabilities, and the technology that allowed that to be efficient. The other part of the equation is if that starts to happen, around the margins, we're seeing kind of a somewhat of a shift in the way that the system's structured. So we're starting to see that Russia is willing to price oil outside of the dollar-based system. they've essentially de-dollarized, so that they hold most of their reserves now in either euro assets or 20% in gold, and a little bit in say Chinese currency. They've kind of de-dollarized, and then you have other countries that are less extreme in that regard. But I do think essentially we're shifting towards a little bit more decentralized global reserve basket, where instead of one world reserve currency, you have a handful of regional reserve currencies and a handful of currencies that can be used to buy oil. So I think it's kind of shifting out globally to some extent.
Thank you, Lyn. That's great. So, Scott, Lyn just gave sort of a reading of history, an analysis of the state of play today, and then some implicit or explicit predictions in terms of where things might go with that last point. How do those differ from how you see the history, the present, and the future?
Well, I'm not sure the advantages the U.S. has from the international use of the dollar are as large as she thinks, as Lyn thinks. It's hard to know for sure, but one thing I would point to is that the patterns that you're seeing in international trade, investment, and so on with the U.S. are not that different from some of the other English-speaking countries. So the English-speaking countries tend to run trade deficits. They tend to see a declining share of GDP and manufacturing and so on. And one common thread here is that you're getting that financed in some other way. For the United States, for instance, we can think of the US as borrowing money very cheaply by selling treasury bonds to foreigners at 1 or 2% interest rate. And then when we invest overseas, we're earning much higher rates of return on our multinational corporations that invest around the world. Because of the difference in rate of return from what we earn on foreign investments versus what foreigners are earning on treasury bonds, we're able to run trade deficits year after year without any sort of day of reckoning. Now, there may be a day of reckoning in the future if that process doesn't continue to play out that way. And I think this is also true to some extent in Canada, Britain, Australia, and so on, but maybe for different reasons. Like in Australia, it might be, imports of goods are offset by sales of assets or whatever in Australia. But for whatever reason, the English-speaking countries show this pattern. And then in Northern Europe, you see a completely different pattern where most of the countries have large trade surpluses and current account surpluses. But how much of that is driven by the fact that the dollar is special? Well, yes, we do borrow at low interest rates because treasury bonds are very popular right now. But other countries, other developed countries, are also borrowing at very low interest rates, except a few cases maybe where there's default risk, like Greece. But generally speaking, the interest rates are low, throughout the developed world. So I don't deny that the dollar has some advantages, both the dollar itself and dollar-denominated debt like treasury bonds. And we have a benefit to the United States from that fact, and that does have some impact on the size of our trade deficit. But I'm just not sure that it's that big an effect. I think that if you look at, again, the other English-speaking countries, you're seeing some of these same trends. So I tend to think that there are other structural issues going on that also explain a big part of this process. And in terms of the decline in manufacturing, a lot of this is, I think, also due to tech. So when I talked about the large profits being earned by US companies around the world, I think a good part of that is probably the tech sector. And, unfortunately for people in manufacturing, that means their comparative advantage of the United States is no longer labor-intensive manufacturing, it's tech. So we're seeing a shift of our economy in that direction. And countries where the tech sector is a little bit less dynamic, like Germany and Japan, have held up somewhat better in manufacturing, although manufacturing is actually declining everywhere as a percentage of the workforce, but it's declining more rapidly in the United States. So I think there's a number of factors going on here. I think certainly what Lyn said is a lot of the points are correct, but I don't think it's maybe the dominant factor. I tend to think of this in terms of the English-speaking countries as a group. What's really driving the persistent current account deficits you're getting in that group of countries? And it's obviously not the US dollar for all the others. So I think there's some other factors as well.
How would you react to that, Lyn?
So I would break it into two different eras. So I would agree that basically the dollar's current system is not benefiting the United States as much as many people think. but I would break that into two different parts. So I would say, from in the 70s and 80s, I think that was a pretty important resource when you're kind of looking in the context of the Cold War, basically ensuring global demand for your debt, your currency, and was a really big key part. It also, gave you geopolitical reach in that important time. I would say that, essentially since the end of the Cold War, so the 90s and onwards, that basically it's not been the advantage that it has been before. And this is a point that other analysts like Luke Groman have made. I think he's been very spot on this observation. And so overall, I would describe it as essentially since the 90s, the drawbacks of having the system have been somewhat larger than some of the benefits. And it's not so much that the United States is able to borrow at lower interest rates. We actually have some of the higher interest rates among developed countries. So if you look at much of Europe and Japan and many other developed countries, the United States is on the top half or the top third of that spectrum generally. It's partially that we're able to borrow at lower real interest rates. So it include basically how we tend to grow our money supply faster. We tend to have higher average inflation. So we generally have a pretty attractive borrowing rates in real terms. That's one variable. And then two, if we talk about the reckoning, right? So how long can you sustain this without a reckoning? The thing I would point to is the net international investment position. So essentially, when you run persistent trade deficits, or more specifically current account deficits for a long period of time, what ends up happening is that the foreign sector owns more and more of your productive assets, your financial assets. And so if you look at Japan and Germany, for example, they're the ones running these current account surpluses structurally. And so they build up very large net international investment positions, which means that they own more foreign assets than foreigners own of their assets. So they own stocks and companies and bonds and land from around the world, and basically have this stream then of interest and dividends and capital appreciation from those investments. Of course, it does depend on what they invest in. If they entirely invest in foreign bonds, then they're going to get a low rate of return. Whereas if they invest increasingly in real estate and stocks in other countries, they get basically they're buying real assets. They're getting higher returns on average. And so a general trend that we've seen over the past, especially the past 25 years, is that foreigners are increasingly taking their surpluses and then they're buying U.S. assets rather than just treasury bonds. So they're buying U.S. stocks, they're buying U.S. real estate, they're buying wholly owned subsidiaries of companies, they're buying U.S. land. And so what the United States has had is essentially a rapidly declining net international investment position. We've gone from, say, the being the world's biggest creditor nation, so having the highest absolute net international investment position, to being by far the most negative absolute net international investment position. But then even when you divide it by GDP, so you look at countries' NIPS divided by their GDP, the United States is one of the lowest in the world now among developed countries, where kind of Spain would also be pretty low, but generally the United States is one of the lowest in the world because essentially the foreign sector owns increasing percentages of U.S. assets. And it's hard to say how long that can go on for. I mean, right now it's maybe negative 70% of GDP. Could it reach negative 100% of GDP? That's certainly possible. But essentially that's not an infinite loop that can go on forever. Eventually that, I think, normalizes and kind of reaches politically untenable levels.
Scott, how would you react to that?
Yeah, I mean, it's hard to predict how that's going to play out. I will say this, though. I've been following this issue for like decades now. I'm pretty old. I'm 66 years old. And I can remember quite a long time ago, experts saying, yes, the U.S. still has a net positive flow of, investment income. So there's still a net flow of investment income to the U.S., even though we're becoming a net debtor nation. But this is, given current trends, this will turn around soon. This can't go on much longer. This was decades ago. And I'm not saying it can go on forever, but we've continued to run larger and larger debts, export more and more treasury bonds and other financial assets. And Lyn's right, probably increasingly we're exporting more high yield assets as well. The Norwegian sovereign fund, I think, buys a lot of US stocks, for instance. But when you net it all out, I believe the flow of investment income is still positive for the United States. And so I'm very leery of predicting anything about a day of reckoning. I mean, obviously, if you go far enough out in the future, these trends will change in one direction or another. But I just don't think we know how long this can go on. And my best forecast would be we're in for a considerably longer period of continued deficits, but probably not a big problem in terms of net flow of investment income. If it does turn around, it'll force the US into more austerity. But of course, this sounds very bad, but from a lot of people's perspective, it might be a good thing because that would force the US to start running trade surpluses. Now, I don't think trade surpluses are necessarily something that should be a policy goal, but many people do believe that. So it's important to recognize that the term day of reckoning sounds painful. And in one respect, it is kind of painful because it would probably force at least a slight cut in consumption or lifestyle of Americans. But that day of reckoning would also involve trade surpluses and probably growth in the US manufacturing sector. So that's an important thing to keep in mind when you hear the term day of reckoning. Now, whether that adjustment occurs smoothly, that's a whole other issue as well. But, I've heard the predictions that this can't go on much longer for so long. And I'm not seeing the intermediate steps that you would expect before it had to end. By intermediate steps, I mean the flow of investment income reversing to a net negative for the United States. So as far as I can see, we're still quite a ways away from the day of reckoning.
Lyn, feel free to respond to that if you have a reaction. I also want to segue into my last question of the show, which is, and it's kind of a big question, but Luke Roman has talked about a bunch about the U.S.-China dynamic, and I'm curious, who do you think basically has more leverage in the dynamic, and how should we think about that sort of financial dynamic?
Yeah, so just going back to tie up the last point, I would say there's a part that I very much agree with and a part that I see differently. So the part I agree with absolutely is that a day of reckoning does not have to be a bad thing in whole. I think it's a big shift, and so that's actually one of the things I've been highlighting in my research as well. That let's say you had those shift in fund flows going out, you'd probably get a weaker dollar, and generally you see countries that handle that transition well. They might get a weaker currency for a period of time, but that makes gives them some degree of austerity so that their input power is weaker, their exports are more competitive, and that, as long as they don't kind of spiral into some sort of deeper problem, that becomes a self-correcting state of affairs. And so I do agree with that part. The part that I would draw attention to is that if you look at the net international investment position of the United States, it's essentially gone exponential in the sense that it's very recently, over the past 10, 15 years, kind of started accelerating to the downside at a very rapid pace. So you had kind of multiple decades of this slow grind where you went from a very surplus position to a gradually towards a deficit position. And then really in the past, say, call it decade, you've really kind of rapidly dug down as you've had this kind of acceleration in trade deficits and kind of a disproportionate increase in U.S. asset valuations compared to foreign asset valuations, especially in the stock sector, less so in real estate. If anything, some foreign markets have higher real estate valuations, but really in the capital markets, in the stock markets especially, you've seen that really big disconnect. And so I would say that's the part that I think is becoming more rapidly unsustainable. Is that huge rate of deepening net international investment position at this pace. Going to the China and U.S. Comparison, I think there's different areas where the countries have very different amounts of leverage. And so, in terms of geography, United States has arguably the best geography in the world in the sense that you have the connection to two oceans, deep water ports, the best agricultural system. And you look at the rivers and things like that, you have a high amount of natural resources. The big challenge that China faces is a couple. One is they're more closed off in terms of geography, right? So in terms of their water borders and number of land borders that they have to manage. And then two, they have various commodity constraints. So they're more likely to run into water issues, energy issues, and food issues, right? So they're more reliant on importing the commodities that they need. So that's where the U.S. has a really big advantage. The disadvantage is that, China now has a very large infrastructure for manufacturing. So even if we wanted to bring back manufacturing, for example, or become more self-sufficient in the global sense, those massive ports don't just build themselves overnight. I mean, those are multi-year, even multi-decade investments that build up over time. So they have a lot of built-up infrastructure that it places them kind of at the center of the global manufacturing hub. And then when you combine that with their Belt and Road Initiative, so their commodity agreements, with multiple different countries, their infrastructure now that goes throughout the rest of Asia, for example, they're very well positioned in terms of that type of infrastructure. In addition, they're very strong in terms of having supply of key metals for electrification of the world. So cobalt, nickel, both in terms of agreements that they've had in order to buy them, but also in terms of the refining capacity. So it's another area where they've invested heavily that the U.S. has maybe not done so very much. And then, of course, United States has that deeply negative net international investment position. China has that positive one. And so kind of the status quo in some ways favors China in the sense that they can keep buying up dollar-denominated assets around the world by running those structural surpluses. They also face, however, weaker demographics going forward than the United States. And so I think it's one of those things where it's like tit for tat. You have these two really large powers, and both of them have almost like insurmountable advantages over the other one. And that's why they're so intertwined and so kind of connected at the hip.
Scott, how would you react to that?
Well, a couple points. One thing China has to think about or worry about a little is that they might work very hard and getting rich by working hard and saving a lot of money, and then end up not getting very rich. And the country I think of here is Germany, which, you would think Germany would be a lot richer than the United States, right? But my understanding is a lot of Germans just invest in bank accounts, not in like Amazon stock or Apple stock, things like that. So somehow the United States has ended up with a lot more wealth in the stock market and so on than a country like Germany. And so for me, I mean, certainly Lyn's right. We have a lot of natural resource advantages in the United States and so on. But I would point to the talent combined with the economic system here as being a big advantage, right? So Silicon Valley could have been anywhere in the world, but it was in the United States. Hollywood could have been anywhere, but it was the United States. Even something like fracking. I mean, think about the fracking industry. It's not here because the U.S. is the only country with oil. We have a small percentage of the world's oil, but we have most of the world's fracking because we're good at doing fracking. And I think that a lot of the anomalous trends we're seeing recently having to do with wealth and financial flows and so on reflect the fact that the U.S. has made enormous gains in industries like high tech, and the country really dominates the entire world in many of these industries. And it's the huge amount of wealth created here has been one of the factors fueling, for instance, our trade deficits and so on. So for a country like China, it can go in different ways. It can kind of become like the United States and develop its own Apple and Google and Facebook and all that. Or it can become kind of like Germany or Japan, like very good at manufacturing, but not really making a big impact in cutting edge industries, and therefore not doing as well in wealth as you'd expect based on the productivity of their workers. I don't know if that makes sense, but so that's kind of the model I'm thinking in terms of more and more is the way that the US really stands out, not so much in worker productivity, but in having a lot of talented people that are producing these world-class companies. And not just in tech, but even in areas like fracking, where there's just for some reason the U.S. is good at doing things that other countries aren't. Now, manufacturing is, of course, the exception. We lag many countries there. But I think the thing that's really fueled our success is that we have a lot of very talented people that are creative in producing successful companies in newer areas. And it remains to be seen whether China can do that. So in the end, I don't think that the barriers to success will be natural resources. It will be more about flexibility, human capital, a dynamic economic system that encourages innovation, those kind of things. And whether China will be successful on that front will determine whether it ends up looking more like the US economically or more like slightly more stagnant, but relatively rich industrial powers.
What you didn't say, Scott, is you don't see the U.S. or China being overly dependent on each other in a way that gives, one an unfair advantage financially.
I don't really like the term unfair. The U.S., I mean, first of all, there's so much emotion in looking at the world that way. How many Americans know that we're the most protectionist developed country in the world in terms of tariffs right now? If you did a poll, we have the highest tariffs in the entire developed world. We're very hostile to the World Trade Organization. We've been trying to kneecap them, make them ineffective. We don't play fair. So I don't like to look at the world that way. Obviously, there's a lot of things China does that I don't like, but I think that the success of countries is not about how they're treated by other countries. It's about what they do themselves. Like, they need to look in the mirror, whether it be China, the United States, or any other country. And if you're not doing well, it's because of what you're doing internally, not because other countries are preventing you from doing well.
I want to be mindful of time here. We're a few minutes over. Lyn, was there any last word you wanted to have on this topic, or anything else that we spoke today? Or
no, I think we covered a broad array of topics. I guess one thing I'm mindful of is that things tend to go in cycles, and again, going to areas where you underinvest in for a period of time, whether it's commodities or infrastructure, that can work out for a while, and then it starts to kind of reverse. And so one way I'd phrase is that the 2010s were very, very favorable to the U.S. in the sense that this was a decade where commodities were abundant for multiple reasons, and you had that period where you could rely on technology very, very heavily to do very well. I think going forward, when we have these kind of strains on globalization, when we're specifically having inflation that's partially tied to global supply chain limitations, I think that having your own infrastructure, your own manufacturing infrastructure, and your logistics infrastructure is going to be increasingly important. So I think that the relative importance of those things tend to go in cycles. Other than that, I mean, I agree that how countries invest plays a large role. I often show this chart. I referenced it earlier. The mean and the median wealth of different countries and the divide between them from data using from Credit Suisse. And Germany, for example, does have lower median wealth than many other European countries. Lower than Italy, for example. It's not something you'd guess from their histories and kind of their current state of affairs, whether it's the relative importance on the global scale or what happens with their sovereign debt. And a lot of it is because they invest in very conservative ways. And one thing you could run into China is that because they invest very, very heavily in their property markets, if they all kind of collectively, as in aggregate, invest in a real estate bubble that pops, that can do a lot of long-term damage to their economic growth prospects. So there are different ways that can play out. The same thing could be true, for example, if say Americans kind of pile into the equity market at say a top and a kind of a period of historic overvaluations, and then if the S&P 500 goes kind of sideways for 10, 20 years, right? That's another way that you can kind of malinvest. So that kind of impacts different countries around the world at different times. So that happened with Japan for periods of time. That could be happening with China right now. And that could be happening in parts of the U.S. right now. So I think that is an important thing to be aware of, that if you have kind of collective malinvestment, that can obviously strategically impact a country for the worse.
Yeah. Scott, is there any last thing you wanted to say before we wrap?
Well, those are real good points. The important thing is to stay flexible. So if you do get into a problem area, you need to have a flexible enough economy to make the transition. And I'm not sure the Japanese actually made the transition properly after the early 90s bust. It seems to me their tech firms are less dynamic than not just the US, but maybe in some cases even South Korea, China, and so on. So flexibility, making sure your economy can adjust when there are periods of malinvestment is also important.
Yeah, that's a good place to wrap. For people who enjoyed the conversation, if you haven't listened to my other episodes with Lyn and Scott, let me remind you that Lyn has a fantastic blog. You can find it at lynalden.com, and she also has a number of other podcast appearances. I went down the rabbit hole recently, and I highly recommend others do so as well. And Scott also has a fantastic blog called The Money Illusion, and we discussed his latest book on market monetarism in a most recent episode that I highly recommend you check out the episode as well as the book. Scott, Lyn, thank you so much for coming on the podcast. This has been a great discussion.
Thanks for having me.
Thank you very much. Sure.
If you're an early stage entrepreneur, we'd love to hear from you. Check us out at villageglobal.vc.